Welcome to The Explainer. Today, we're putting on our detective hats to solve a classic financial mystery. So let's start with a real head-scratcher. You've got a company posting massive profits, looks like a huge success on paper, and then, seemingly out of nowhere, it can't pay its bills and completely collapses. How on earth is that possible? Well, the clues are hiding in plain sight, but only if you know exactly where to look. To crack this case, we first have to get our heads around something called the profit paradox. And really, it all comes down to the huge difference between looking profitable and actually having real, spendable cash in the bank. The mystery starts to unravel when you realize companies use two different ways of looking at money. You've got the income statement, which tells us all about profit. It uses something called accrual accounting. Now that means it records a sale the second the invoice goes out, even if the customer hasn't paid a dime yet. But the cash flow statement, it's completely different. It's a pure cash tracker. It only cares about actual money moving into and out of the company's bank account. This brings us to a famous saying in the finance world that really gets to the heart of our investigation. Profit is an opinion, cash is a fact. Think about it. A company's profit can be shaped and molded by accounting rules, making it more of an interpretation. But the amount of cash sitting in the bank, that is an undeniable, cold, hard fact. So to be a good financial detective, you've got to use a tool that just ignores all the opinions and simply follows the money. And that tool, our key piece of evidence in this whole mystery, is the cash flow statement. Now, the cash flow statement is one of the three main financial reports, right up there with the balance sheet and the income statement. But its entire job is to tell you one specific story, a clear, detailed account of where a company's cash came from and where it went. You could say it's the ultimate truth teller.
The real genius of this statement is how it's organized. It doesn't just give you one big, confusing number. Instead, it sorts every single cash transaction into one of three simple categories. Think of them like three buckets, each one telling a very specific part of the story.
So here are our three buckets. First, you have operating activities. This is all the cash from the company's main business, making and selling its stuff. Second, you've got investing activities. This tracks cash spent on or made from big-ticket items, like buying a new factory or selling off old property. And third, there's financing activities. This follows the money moving between the company and its owners or its lenders, things like taking out a new loan or paying dividends to investors. When you think about it this way, it all starts to make sense. You get cash from a customer, that's an inflow from operations. You buy a new piece of machinery. That's a cash outflow for investing. You take out a bank loan. Well, that's a cash inflow from financing. See? Every single dollar has its own little story. All right, so we have our tool and we know how it works. Now it's time for the aha moment. This is where we connect all the dots and finally solve our original mystery. How can profit be such a lie? One of the absolute most powerful things we can get from this statement is something called free cash flow, or FCF. The easiest way to think about it is as the company's take-home pay. It's the actual, real cash that's left over after paying for all the essential stuff needed to keep the business running and growing. This is the money that's truly free to be used for other things, like paying off debt or rewarding investors. Now look at this. This right here is where the detective work pays off big time. For this made-up company, Company XYZ, the reported earnings per share, the profit, is climbing up and up. Looks great, doesn't it? But wait a minute. Look at its free cash flow per share. It's falling off a cliff. The profit story and the cash story are going in completely opposite directions. This split, this divergence, is a massive red flag. The income statement is telling you the company is getting more and more profitable, but the actual cash is disappearing. So as a financial detective, you have to ask the most important question. Where did the money really go?
And the cash flow statement is what holds the clues. A negative trend could mean unsold products are just sitting in a warehouse tying up cash. It can mean customers are taking longer and longer to actually pay their bills. Or maybe the company's own suppliers are getting nervous and demanding to be paid faster, draining cash out the door. And in some serious cases, it can even point to management trying to fudge the numbers to make things look good on paper.
And listen, this isn't just some theory. Financial regulators report all the time that they find major errors and misclassifications in cash flow statements. This just hammers home how critical it is to look at this document closely, because it's a place where the truth can sometimes get buried, either on purpose or by accident. So, let's tally up the evidence. The cash flow statement is the ultimate reality check. It cuts right through the noise and the opinions to give you a clear, honest-to-goodness picture of a company's ability to actually generate and manage cash. In the end, the whole statement gives you a simple but incredibly powerful summary. It adds up all the cash from operating, investing, and financing to give you that one crucial bottom line number, the net change in a company's cash. No opinions, just the facts. So the next time you're evaluating a business, remember the lesson from this financial detective story. Are you going to check its profit? Or are you going to follow the cash?